Hello everyone, welcome back to Gold Rush Reporter, your go-to channel for all things silver. Before we dive in, make sure to hit that subscribe button so you don't miss any updates, because silver is moving fast and you want to stay ahead of the curve. Now, let's get straight to it. We have huge breaking news in the silver markets. The markets opened Sunday night, and silver has already skyrocketed several dollars in a matter of hours. A few hours ago, we were looking at $72 per ounce, but now silver has already jumped past $75, hitting as high as $75.51. This is a major move and shows how volatile and exciting silver can be, especially in early trading sessions. If we look at the charts, you can see these moves on many charts, showing the immediate jumps. But even when you zoom out to 30-minute charts, the overall picture is clear. Silver is on the rise. The previous dip to $72 looks like it has established a support zone, forming a base for future upward movement. Think of $72 as the floor and the $75-76 range as initial resistance. It's the market testing its levels. Now, I want to be very clear. I'm not a psychic. I don't have a crystal ball, and anyone claiming to know exactly where silver is going is misleading you. There are too many unknowns, especially in a market as speculative and manipulated as silver. But what we can say is this: silver is responding to accumulated demand and market dynamics. Once Monday starts in full force, more money from gold investors, crypto investors, and other markets could flow into silver, amplifying this move. Why does this happen? Silver is much smaller than gold, only about 3% of the size of the gold market. That means when money flows into silver, the price reacts more dramatically. This is why silver is called gold on steroids. It hits higher highs and lower lows than gold. The volatility works both ways, but for investors who understand the market, it's an opportunity to capitalize on significant gains. Of course, this volatility also attracts manipulation, especially from large institutions. Banks and traders use techniques like spoofing, where false buy or sell orders are placed to influence market perception. Historically, JP Morgan, Merrill Lynch, and even Dutch banks have been caught doing this. JP Morgan alone faced a $920 million fine, and several employees went to prison for market manipulation. These examples remind us that the silver market is not just about supply and demand. It's also about strategy, control, and influence from large players. That said, regardless of manipulation, what we're seeing now is real buying pressure. Silver has bounced back quickly from $72 to $75 plus, signaling a strong underlying trend. For long-term investors, this is exactly the kind of moment where dips become opportunities. You don't need to watch the price every minute. Those of us who have been stacking silver for years know that the bigger picture is what matters, not the day-to-day fluctuations. Another important point: silver is not a get-rich-quick scheme. My new book, Silver is the New Gold: Divorcing the Dollar That's Designed to Enslave You, covers this in depth. It emphasizes that silver is about preserving wealth and creating real value, not chasing temporary spikes. The recent correction from all-time highs above $80 to $72 shows that market timing is unpredictable, but disciplined stacking over time leads to wealth accumulation. To wrap up this part, here's what's critical to remember. Silver's recent jump is exciting, the market is volatile, and $72 likely formed a support base. The 75 plus level is a resistance test, and with Monday approaching, momentum could push prices higher. But always focus on the long-term strategy, stacking for wealth preservation, not speculation. Silver's rapid move from $72 to over $75 in early Sunday trading highlights a fundamental truth. Silver is extremely volatile, far more than gold. Its small market size, roughly 3% of gold's market, means any large inflows of capital can push prices higher or lower in dramatic fashion. That's why silver is sometimes called gold on steroids. It amplifies price movements, hitting higher highs and lower lows. This volatility is both a risk and an opportunity. The flip side is manipulation. Large institutions, banks, and traders have historically influenced silver prices using methods like spoofing, placing false orders to create the appearance of demand or supply, then canceling them before execution. This tricks other traders into reacting to false signals, creating temporary swings. JP Morgan, for example, faced a $920 million fine, and 3 employees went to prison for manipulating silver prices. Merrill Lynch and the Dutch bank were also caught doing similar practices. These examples illustrate that manipulation exists, especially in the futures or paper markets, but the physical silver market's supply-demand fundamentals remain strong. Now let's talk about the recent correction. Silver fell to $72 after hitting all-time highs above $80. That dip was a natural response to a parabolic rally, a period of overbought conditions. But this $72 level now appears to be a support base, giving the market a foundation for the next move up. As we've seen, silver quickly rebounded to 75 plus, showing that demand remains strong and buyers are stepping in at lower levels. For long-term stackers, this is exactly the type of scenario to accumulate more metal, not panic. Psychology plays a major role here. Many investors buy after the price spikes, seeking confirmation that the rally is real. The problem is they often miss the best buying opportunities, which occur during dips or periods of uncertainty. Experienced stackers know that buying during corrections maximizes long-term gains. The market rewards patience, not hype chasing. Speculative flows further amplify volatility. When money moves from gold, cryptocurrencies, or even equities into silver, the price reacts faster and more sharply due to the market's smaller size. That's what we're witnessing now. A few hours of trading caused a several dollar jump. These exaggerated movements can feel chaotic, but they also create opportunities for disciplined investors to buy low and hold. Another factor driving silver's appeal is its scarcity and industrial demand. As global supply struggles to keep pace with consumption, every correction becomes a buying chance for those who understand the long-term picture. Unlike paper assets, silver represents real, tangible wealth that isn't easily devalued by inflation or central bank policies. Finally, let's remember the long-term perspective. Silver is not a get-rich-quick asset. It's about wealth preservation, turning fiat money, paper dollars losing purchasing power, into real value. Accumulating silver over time, especially during dips like the recent $72 level, is a proven way to protect and grow wealth. Market swings, manipulation, or speculative hype are short-term distractions. The long-term trend remains structurally bullish. Silver's recent surge from $72 to 75 plus is not just a short-term spike. It's part of a larger, structural trend that ties directly into the weakening of fiat currencies and rising global demand for tangible wealth. Understanding this relationship is critical for anyone stacking silver or evaluating the market from a long-term perspective. First, let's talk about the dollar's declining purchasing power. Every dollar in circulation today is worth less than yesterday, and this erosion accelerates over time due to rising national debt, inflationary policies, and central bank interventions. The US national debt currently exceeds $35 trillion, and deficits continue to grow. When you put your wealth into fiat currency, it's effectively losing value day by day. This is where silver steps in as a direct hedge. It's a physical asset with intrinsic value that is globally recognized. Unlike dollars or bonds, silver cannot be printed at will, making it a scarce and finite resource. Second, silver's industrial demand is exploding. It's essential in electronics, solar panels, EV batteries, and other high-tech industries. As more countries adopt green energy solutions and technology continues to advance, silver demand is only going up. Combine this with supply constraints, mines cannot keep up, and countries like China have restricted exports. And the structural supply-demand imbalance becomes evident. Scarcity plus necessity equals upward pressure on prices. Now, let's consider the psychology and strategy for stacking silver. Many new investors see the market's volatility and expect quick profits. This is a trap. Silver is not a get-rich-quick scheme. It's a wealth preservation tool. The real value comes from consistently accumulating metal over time, taking advantage of dips like we saw at $72. The correction was not a threat, but an opportunity. Smart stackers know the market's temporary fluctuations are moments to increase their position at lower cost per ounce, improving long-term gains. A key concept here is the difference between investing and gambling. Investors base decisions on research, scarcity, demand, and market trends. Gamblers react emotionally, chasing hype or hoping for a fast spike. Silver requires strategy, not luck. When you understand the macroeconomic forces, fiat devaluation, industrial demand, and supply constraints, you can make informed decisions that tilt the odds in your favor. The paper versus physical silver market also plays a critical role. While futures contracts and exchange-traded instruments allow for leverage, they are often manipulated by large institutions. Physical silver, in contrast, is tangible and immune to these manipulations. By holding physical metal, you bypass the distortions of paper markets and secure true, lasting wealth. The recent spike from $72 to $75 illustrates how quickly market sentiment can shift. But for physical holders, short-term volatility is less relevant. Additionally, consider long-term trends. Inflation, central bank policies, and geopolitical instability all create structurally bullish conditions for silver. The metal's history shows resilience over decades, maintaining value even when fiat systems collapse or underperform. When stacked correctly, silver is not just a financial asset. It's a tool for independence and financial sovereignty, turning unstable fiat into enduring wealth. Finally, the takeaway is clear. Buying silver during dips, understanding the macroeconomic backdrop, and focusing on long-term accumulation is the path to maximizing wealth preservation. Temporary spikes or dips are secondary. The real strategy lies in maintaining exposure to a scarce, highly demanded asset that is fundamentally disconnected from the failings of fiat currency systems. Silver's price movements are not just about supply and demand. Market mechanics and institutional activity play a massive role in shaping the short-term landscape. Understanding these dynamics is crucial for anyone serious about stacking silver strategically. The first key point is the difference between paper and physical silver markets. Paper silver, primarily traded through the COMEX and other futures exchanges, allows investors to speculate on silver's price without owning physical metal. While convenient, this market is vulnerable to manipulation and leverage, meaning large players can influence prices through methods like spoofing, sudden margin adjustments, or massive buy-sell orders. For example, JP Morgan paid a $920 million fine for manipulating silver markets, and other banks like Merrill Lynch have been involved as well. These events illustrate that short-term price swings often reflect institutional activity rather than true scarcity. That said, physical silver is different. Its value is rooted in real-world scarcity and industrial demand, and it cannot be manipulated in the same way as paper contracts. This is why savvy stackers focus on acquiring physical silver, coins, bars, or verified bullion, rather than betting solely on futures or ETFs. Holding metal ensures that your wealth is tangible, secure, and insulated from exchange-based distortions. Recent price behavior reinforces this lesson. Silver dropped to $72 during a correction after exceeding $80, then quickly rebounded to $75 as buyers stepped in. This volatility is classic in a small, highly traded market. Compared to gold, which is much larger and moves more slowly, silver reacts dramatically to inflows, outflows, and institutional maneuvers. These exaggerated swings can feel chaotic, but they also create opportunities for disciplined accumulation. Another important factor is margin requirements and exchange policies. When CME or COMEX adjusts margins for futures contracts, traders must post more capital to maintain positions. These moves can trigger rapid selling or buying, affecting prices temporarily. While it might look like market panic or speculation, it's often just a mechanical adjustment imposed by the exchange. Understanding this helps stackers avoid overreacting to short-term fluctuations and focus on long-term accumulation. Institutions also influence silver through strategic hoarding and trading patterns. Large banks often hold massive short positions, meaning they have sold contracts they don't physically own, betting prices will fall. This can suppress silver prices temporarily, creating a disconnect between paper and physical markets. Yet, despite these manipulations, real-world supply remains limited, and demand continues to grow. Over time, the physical market exerts pressure, and paper market distortions eventually correct themselves, pushing prices higher. It's also critical to recognize that silver's volatility works both ways. It can spike rapidly in response to global events, macroeconomic shifts, or industrial demand, but it can also pull back sharply. For stackers, the strategy is clear: buy during dips and hold through spikes. Attempting to time the market precisely is risky because of institutional influence and speculative volatility. Finally, the long-term outlook remains structurally bullish. Supply constraints, growing industrial demand, global silver hoarding, and fiat currency weakness all converge to create a favorable environment. Stackers who focus on physical accumulation, strategic purchasing during corrections, and ignoring short-term hype position themselves to benefit from decades of potential growth. Silver is not about quick profits. It's about securing real wealth and maintaining purchasing power against an increasingly unstable financial system. We've covered the volatility, the manipulation, and the institutional activity driving silver prices. Now it's time to focus on what you, as a silver stacker or investor, should do to maximize your long-term wealth. This is where strategy meets execution. First, understand that silver is a long-term wealth preservation tool, not a get-rich-quick scheme. The recent moves, from $72 to over $75 in a matter of hours, showcase volatility, but the real value of silver is in its ability to protect your wealth against inflation and fiat currency devaluation. Unlike dollars, which lose purchasing power every year, silver retains intrinsic value because it is scarce, globally recognized, and industrially indispensable. By holding physical silver, you are effectively divorcing your wealth from a failing system. Next, focus on buying the dips. The recent correction to $72 was an opportunity, not a setback. Markets rarely move in a straight line, and short-term pullbacks in a bull cycle are inevitable. Smart stackers accumulate during these dips to lower their average cost per ounce, positioning themselves for higher gains when prices recover. This is basic investing logic. Buy low, hold high, and let compounding scarcity work in your favor. Another critical consideration is physical versus paper silver. Paper contracts, ETFs, and futures are tools for speculation, but they come with systemic risk and manipulation. Physical silver, bars, coins, and verified bullion is immune to these manipulations. Owning metal in your possession or in secure storage ensures that you benefit from true market scarcity rather than short-term exchange fluctuations. Building a direct relationship with a reputable dealer is another important strategy. Dealers like Miles Franklin provide access to inventory that may not be available online and allow you to establish a trusted connection for both buying and selling. Over time, this relationship ensures that you are plugged into the market in a way that casual buyers cannot achieve. It also helps avoid inflated premiums, ensuring that you acquire silver at competitive, sustainable prices. Stacking silver is also about strategic patience. Price swings are temporary, but scarcity is permanent. Governments like China, restricting exports, global industrial demand, and ongoing market manipulation create structural constraints that will support silver's value over the long term. Your job as a stacker is to hold through short-term volatility, resist panic selling, and focus on long-term accumulation. Education is equally important. Knowing why silver holds value, how the dollar loses purchasing power, and understanding the global market landscape allows you to make informed decisions rather than emotional ones. Investors who fail to understand these fundamentals often buy at highs and sell at lows, undermining their wealth. Strategic stackers view silver as both a financial asset and a hedge against economic instability, which is why books like Silver is the New Gold are invaluable. They provide context, history, and actionable insights. Finally, think in terms of generational wealth. Many investors accumulate silver not to sell next month, but to pass on to their children or grandchildren. The ultimate benefit of stacking silver is long-term preservation and growth of real wealth. Short-term price validation is irrelevant. What matters is that your portfolio consists of a finite, valuable asset that cannot be arbitrarily devalued. To summarize the strategy, accumulate during dips, not highs. Focus on physical silver over paper instruments. Build a trusted relationship with a reputable dealer. Ignore short-term hype and volatility. Think decades, not days. Educate yourself on macroeconomic trends and dollar devaluation. Plan for long-term wealth preservation or generational transfer. Silver's current market conditions, volatility, manipulation, industrial demand, and scarcity create one of the most favorable long-term environments in decades. By being strategic, patient, and informed, stackers can protect their wealth, benefit from market inefficiencies, and position themselves for a new era of silver-driven prosperity. This is the mindset of a true silver investor. Disciplined, patient, and focused on real wealth accumulation, not fleeting profits. The short-term swings will come and go, but the fundamentals will always prevail, rewarding those who stick to the strategy.